Hello and welcome to Investment Blueprint for Passive Investing, curated by experts at Motilal Oswal. I'm Muzammil and today we'll be helping you choose your first passive investment with none other than Mr. Pratik. In the last episode, we talked about how to decode a fund document. We helped viewers decode the fund document and discussed various parameters like tracking error, tracking difference, TER, and AUM that one should consider while choosing a passive fund. If you haven't watched that episode yet, be sure to check it out. Without making you wait further, let's jump into the topic of today's video and help you pick up your first investment portfolio. Are you ready, Pratik? Let's
get started.
Awesome. So with this, I want to first ask you a very common question, that is, when somebody starts investing, what are the most common mistakes that you've seen people make when they choose their first investment for themselves?
Yeah, I think one of the most important things that people don't do in investing is to understand themselves.
Yeah.
I think in life, when you have to find a career or you have to find a partner,
Yes.
I think the first step is to understand yourself before you go out there and look out for something.
Yes.
But I think in investing, a lot of people miss out on that aspect. And I think because they don't understand themselves, they end up making a lot of mistakes because they tend to go with herd mentality.
Yes.
When you don't know yourself, you go towards what's popular, and inevitably, in investing, herd mentality is a wealth destruction sort of advice.
Yes.
So I think the most important thing is identifying your goals, investment goals. So what are you investing for? Very important is to understand your risk appetite.
Yeah.
So what are your goals? What are you saving for? How much of risk can you take, as a person? Which obviously is not an easy question to ask, but over time you will be able to, understand a lot better.
Yeah.
And third is, what should your allocation be?
Definitely.
On the basis of your risk profile. So I think people who don't understand these three things, tend to make a lot of mistakes when they start investing. So I think these are three things which I would say investors need to think about before.
That's interesting, Pratik. Can you explain to us why looking out for investment goals, risk appetite, and asset allocation as important as you're saying it is?
Yeah, so all three are extremely important, and I think it's important to understand yourself, but it's also important not to wait too long.
Yeah.
I think you shouldn't spend 2-3 years thinking about these things.
Yes.
This should be a one-time activity, and you can revisit it, say, every 6 to 8 months time.
Okay.
But the reason why investment goals are important is because it really designs your horizon to invest.
Okay.
So suppose you have your goal is, so you're 35 years old, and if you're looking at retirement,
Yeah.
you're looking at 25-30 years of investing, where
Okay.
you are able to take more volatility and risk in your portfolio.
Yeah.
So goals are very important, and I believe that a lot of people misconstrue goals with age.
Okay.
They feel like if you're younger, you're more risk taking. If you're older, you're less risk taking. I think it really depends on your goals.
Yeah.
Suppose there's an 85-year-old who's saving for his grandkids.
Yeah.
Then he can take a lot of risk. Whereas a 35-year-old who wants to buy a house in 6 years' time
Yeah.
cannot take a lot of risk.
Yes.
So I think risk appetite, or at least should be on the basis of what your goals are.
Yeah.
That's number one.
Okay.
Number two is risk appetite. Once you know, say that these are my goals,
Yeah.
how much risk can I take?
Yes.
And this is very important because most investors tend to just optimize for returns. They're like, boss, कौन सा fund है जहाँ पे मेरा return सबसे ज़्यादा बनेगा?
Yeah.
And inevitably what happens is that fund ends up becoming a very risky fund. So I think it's very important for investors to understand how much of risk can I take as a person.
Definitely.
Am I okay with my portfolio going down by 20%, or 30%, or 40%?
Yeah.
And these are short term. Obviously, long term your portfolio will do well, but in the interim, anything can happen.
Yes.
Markets can fall. Like COVID, for example, market fell by 30%, 40%. So I think you have to really understand, what is your risk appetite towards volatility. And if you think that you're a very conservative person, then you should ideally have a small equity allocation and larger fixed income allocation.
Yeah.
So I think your risk is very important. What I have seen is that people tend to be over risky during good markets,
Yeah.
and very conservative during bad markets, and that is not a good thing. You should have a consistent risk profile.
Okay.
If you are risky, you stay risky unless say over a long term you want to change it.
Yeah.
But ideally you should stick with one risk profile.
Yeah.
That's very important.
Or you could keep it goal based, like you said.
Or you can keep it goal based. Absolutely. Third is your allocation. I think based on the risk in your goals, you should figure out what your allocation should be in different funds.
Yes.
Ideally, if you're looking at a conservative portfolio, then ideally you should look at a, say, 30%, 40% allocation to equity, which can be in a large cap or a mid cap.
Okay.
Or you can have fixed income, sort of 50%. You can have some, commodities exposure. So I think your allocation is probably the most important decision you will make, not the
Okay.
selection. There is a statistic in investing
Okay.
that 90% of your long-term returns,
Yeah.
so the returns that you will make in say 20, 25, 30 years or even in 20 years,
Yeah.
90% of that will come from your allocation,
Okay.
not your fund selection.
Acha.
So whether you buy this fund or that fund does not
doesn't
matter.
matter.
What really matters is how much of your wealth is distributed across equity, fixed income, gold, international,
how you proportion-
real estate, how
yeah.
you proportion that.
Okay.
So allocation is extremely important, and that's why I think people tend to over-optimize on which fund to buy.
Yeah.
Should I buy this mid-cap fund versus that mid-cap fund? I think what's important is people need to optimize for what should my allocation be.
Yeah.
That's why these three things are very important, and I think investors should be relatively comfortable with the decisions on these three things before
Yeah.
they can start making their first investment.
Definitely. While you're talking about asset allocation, I could visualize myself doing some mistakes in the past, which I've done. That you've allocated, we've taken a lot of risky products and given a lot of allocation to that. And I suddenly realized that my portfolio base is very volatile. Every time something goes off, my portfolio goes for a toss.
Yeah.
Does that also mean that passive instruments in general, or any instrument for that matter, building a strong foundation for your portfolio is very important? Would you say that? Considering there's so many types of funds out there, there's so much risk appetite that you have to look about, asset allocation that you have to look about. Do you think the first step would be to build a base on which you can build this portfolio?
Yeah, absolutely. So I think there's something called core, or in your case, a foundation of a portfolio,
Yes.
which you ideally never touch.
Okay.
Very rarely do you touch. And that is a fund which is very simple. The fund that you can see yourself investing for 10, 15, 20 years, however long it is. And I think that foundation ideally is very important because that's your core of your portfolio.
Okay.
And I think that is something which can come in a passive fund or an index fund.
Okay.
And the reason why I say is because unlike say an actively managed fund where performance can be good or bad, in a passively managed fund, you're basically tracking the benchmark.
Yeah.
So you're never worried about bad performance. You're never worried about will it perform badly. You're tracking the market.
Yeah.
And I think that's much easier for you to invest in that fund for say a long time.
Yeah.
You're not worried about should I sell this or not.
Okay.
So I think a passive fund like a Nifty 500 fund, where you're buying the top 500 companies in India in index, is an absolute great start in terms of building a foundation for your mutual fund. Also, in a passive fund, the foundation is good because you're investing for a long time.
Yeah.
So fees matter. Obviously, you want to save a lot of fees. You want more of your money
Yeah.
invested in an underlying fund. And also, I think you want something that has an incredible track record. Like a Nifty 500, where you can see what's happened 5 years, 10 years, 15 years, 20 years.
Yeah.
So if you're planning a goal, you know that the Nifty 500 has delivered roughly around say 12 to 14%.
Yeah.
So if I'm looking at retirement, or I'm looking at buying a car or a house, that's how much I could model my growth to be based on the past performance. So I think a Nifty 500 can be a great foundation for your portfolio.
Okay.
And I think investor looking at I think having a foundation, this could be one option.
Yeah, and 500 companies for somebody who's just starting off or maybe building the base, I think makes a lot of sense, because then you're mitigating across so many ways that you spoke about in the second episode.
So Nifty 500, you are getting large caps, mid caps, small caps.
Everyone.
You're getting all the sectors. You're not having any bias of any sort. So I do believe that it's a great fund where you can get a wide range of companies, sectors. And obviously the risk is and expenses are quite low.
So would you also suggest people to look at Nifty 500 as a first starting point for their investment? Like a lot of people who are watching us today, maybe these are the kind of people who've not built their portfolios yet. They're on the fence trying to make a decision.
No, absolutely. I think a Nifty 500 or Nifty 50, Nifty 500 are excellent funds for you to start building a portfolio.
Okay.
So I think if you ask Warren Buffett, the one fund that he would recommend in everyone's portfolio, he would say an S&P 500.
Yes.
And the Nifty 500 is an equivalent to that fund, the India equivalent of that fund.
Yes.
So I believe that it's no-brainer in terms of having a foundation.
Yes.
And it's a fund that I see when I see a lot of investors investing in it, I don't see them selling it.
Yeah.
Because it's not sector based or it's not it's a very
it
well
represents the
diversified
market in a way. The entire market there
exactly.
is. Yes. So one of such interviews that I saw of Warren Buffett, he said, if you believe in the growth story of the country, then you should invest in the index such as S&P 500. And that's true for India also. India stands at relatively better in a lot of matrices that keeps our growth story intact, I believe.
Yeah, yeah.
And Nifty 500 can do definitely a better job at, mitigating risk across all the places that you spoke about. I am very curious, does Motilal Oswal also have a Nifty 500 product?
Yes, we do. So yeah, we
Okay.
have a Nifty 500 index fund. So
Okay.
again, it's a simple index fund. You can set up SIPs, you can invest lump sums.
Okay.
Yeah, it's I think also very low cost, and
Yeah.
it's also very efficient. I think the tracking error of that fund is 0.03%.
Okay.
So
0.03.
it's 0.0. So it's very, very efficient also. So investors who are looking at this fund, can look at our fund as well.
I would also wanted to know on a personal note, if I'm making the first investment, would you want it to be a lump sum or an SIP? First time ever, a lot of people are watching Nifty 500 right now. Would you want them to start with an SIP or a lump sum?
Yeah, I think it really, again, I think lump sum and SIP really depends on the person to person. So
Okay.
I would say that, if you have money lying in the bank account that is making you, that is not even beating inflation.
Yeah.
Even FD, by the way, does not beat inflation. So
Yes.
by putting your money in FD, you're getting poorer every year.
Yes.
So I think if you have a lot of money that's lying around, then yes, you should make it work by
Okay.
investing in Nifty 500. And if you, sort of don't have the corpus, then you can start off with an SIP.
Okay.
So I think it really depends on person to person. If you are scared of, the market's too high,
Yeah.
or the markets are too volatile, then it's important to participate. The beauty about an SIP is that even if you invest in the peak of the market,
Yeah.
you still make a lot of money
Yes.
because you're averaging down. So I think, really depends. Maybe a combination of lump sum and SIP works very well.
Awesome. So, thank you very much for sharing this. I guess this was one of my personal questions as well. A lot of us know a lot of things about investing in Nifty 500 right now, and I'm pretty sure they're considering this product to begin their investment. I wanted to also ask you to, push a task with regards to Nifty 500. Considering the first part of the episode, we spoke about how asset allocation, risk appetite, and goals are relatively important. We would want the viewers to also go through that journey and identify that for themselves. Would you like to share a task that will allow them to come to a situation where they can consider Nifty 500?
Yeah, absolutely. So I think the task for this video is you have to figure out your investment goals, risk appetite, and asset allocation, the three most important things before you make a decision. Write them down and try to be as specific as possible. Once you have a clear understanding of your investment profile, start researching passive investment options that align with your goals and risk tolerance. Consider Nifty 500 index fund as one of the options and compare it with others. And you can share your findings and insights with others in the comment section below.
Awesome. One question before you go. Is there any closing remarks on why Nifty 500 and not Nifty 50?
Honestly, there's not, both are, I would say, very good for wealth
Yeah.
creation. I think you cannot go wrong if you're buying the top 50 versus top 500. We believe that Nifty 500 is slightly superior
Okay.
because it's slightly better diversified.
Okay.
Because Nifty 50 would be fairly concentrated on the top 20 stocks, where Nifty 500, you're basically spreading your money over a lot more companies.
Okay.
That's number one. Number two, Nifty 500 would have a small and mid-cap exposure,
Okay.
which have historically given you a lot more growth sort of in your portfolio.
Okay.
Because smaller companies historically have delivered more growth than large companies.
Okay.
So I think that also will play out in this portfolio.
Makes sense.
And lastly, I think Nifty 500 is not large cap biased. So you're basically buying a sort of a multi-cap portfolio. Which
Okay.
I think in your which we believe is a slightly better foundation in your portfolio
Yeah.
than just a large cap fund.
Makes sense. Now, when you look at it, it sure looks like a multi-cap mutual fund. Thank you very much for this valuable information. I'm sure everybody who's watching this video have understood the criticalities of Nifty 500, Nifty 50, understanding your goals, risk appetite, and asset allocation. But with that, I also want to remind you that if you're watching this episode, be sure to watch the previous 4 episodes so that you know how we've arrived to this, how we've arrived to knowing ourselves better as investors and making decisions that will make sense for your financial journey. So please watch those videos and also recommend others, your friends, family members to watch these videos so that they can also pick up these tasks and make a portfolio along the way. So with that, I would like to take your leave And be sure to like and subscribe our channel. That's me, Muzammil and Pratik, signing off.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.